Welcome to today's GNCC Espresso webinar, all about tax hacks for your 2022 return. This time of the year can give us headaches as we need to examine the changes and updates to ensure that we maximize our tax filings. Changes are constant, and we are pleased to be joined by two experts who can shed a light on all things related to taxes today. My name is Mishka Balsom, and I will be your moderator for the next hour. But before we start our dialogue and the presentations, I am joined today by Dan Carroll, who's a senior financial planner with Meridian Credit Union, Ontario's largest and Canada's second largest credit union. And our thanks go to Meridian for bringing this webinar and making this webinar happen. Dan, over to you.
Thank you, Mishka, and good morning, everyone. And once again, my name is Dan Carbone, and I'm a senior financial planner here with Meridian Credit Union. We are very proud and always happy to partner with the Greater Niagara Chamber to help sponsor great initiatives like these seminars to our amazing local businesses. Many of you already know that Meridian offers a full range of business product suite to help you continue to grow your business and maintain your success. Everything from day-to-day banking, payroll services, lending and credit, POS terminals, and also access to our wealth team, which is where I would come in and a lot of our great financial planners. We consider ourselves, the best kept secret at Meridian because we work alongside you and your team to build a holistic financial plan, including day-to-day questions, investments. We talk retirement, estate and succession planning, as well as the main topic of today, which is tax. How do we keep more money with you and your family and less going to, let's say out the door? We can bring in specialists to assist with any complex tax strategies like today, where we have partners like Doug Carroll and great access to accountants like Bill from MMP, where we can talk all those complex pieces and work alongside your team to make sure that you can continue to live your best life. With that, I want to make sure that we have more time to listen to Doug and Bill and the great speakers that we have today. If you do have any questions, Mishka, I believe you have access to all of my information, so you can please reach out to the Greater Niagara Chamber, and we'll be happy to assist with any questions that you do have. As well, you can find me on LinkedIn or Twitter, where I post a lot of different financial planning pieces. If you find that helpful, you can always add me there as well. Okay, with that, over to you, Mishka.
Dan, thank you so very much. And we'll make sure to actually also share your contact information in our chat to all of our attendees as well. And now it is my great honor to actually introduce the two panelists that we have with us today. Bill Crysler, he is a member of the MNP Tax Services team right here in St. Catharines. He's a trusted advisor and builds strong relationships with his clients, analyzing each client's situation to provide them with the tailored options to address their unique needs. And all of our needs are very unique to us. Bill is a graduate from Brock University with a Bachelor of Accounting with honors. He's a chartered professional accountant and qualifying as a chartered accountant in 2010. Bill has completed CPA Canada's in-depth tax courses, parts 1, 2, and 3. Bill works one-on-one with private enterprises and small businesses, and he brings more than a decade of tax and financial accounting experience to his role at one of the big 4 firms and as a partner in his own firm prior to joining MNP. Bill, thank you for being with us. And Doug Carroll is a tax and estate specialist with Aviso Wealth, a national integrated financial services company serving the wealth management needs of virtually all of Canada's credit unions, as well as a range of independent financial organizations. Doug holds a bachelor's degree in business administration, a JD, and a master's of law with a specialization in taxation. He's also a trust and estates practitioner and a certified financial planner, and previously sat on the board of directors of the Financial Planning Standards Council, overseeing the body of the CFP professionals in Canada. He has held roles in the life insurance and investment industry at both the supplier and distributor level. Combined with his hands-on experience running an estate planning law practice, he is able to offer practical insights in personal wealth matters. But many of you might be familiar with his name, as he is an active contributor and has been quoted in financial industry media, among them the Globe and Mail, National Post, Toronto Star, CTV, and many more. Too many to mention. So Doug, thank you very much for being with us as well.
Thank you.
And the same goes to all of our attendees. Just to give you an overview of today's format, we are really aiming it to be extremely interactive. We have 2 presentations, each about 15 to 20 minutes long, followed by any questions that you might have. Please utilize the chat function at the bottom of your screen, and we will actually see the questions coming in, and we're very much committed to addressing all of them within the hour that we have together here. If you wish to enable live transcript, please refer to the bottom of your Zoom screen again for that option. And lastly, just a heads up that today's session is recorded, will be made available to all attendees as well as on our website. And on that note, after this introduction, I am first going to move it over to you, Doug, for your presentation, at which time we then move it over to Bill, followed by our question period. So Doug, over to you.
Okay, I just pushed my screen up. I just want to, if you can give me the thumbs up, Mishka, that you can see that we're going. Yeah. Okay,
yeah.
So I'll take you through this this topic that I have the title of it, corporate investment portfolios, and I'll bring up the overview so you can see the series of topics that I'm going to take you through. When I'm speaking on this, quite often it's a much longer time period that I might be speaking on it. So I'm showing you the entire agenda, and I'm only going to go through the core aspects of it. I'm not going to go through a deep down into any of them beyond the again the core parts of it, so that I can give you a sense of what's involved here. What I'm doing with this is basically laying groundwork of some things that you might be quite familiar with in terms of how you run your business and the tax decisions that you made in setting up your business in the first place, and the interactions you have with your accountant on a year-to-year basis with your distributions to yourself, whether that's dividends or salary that you're taking, and laying it out in a visual way as much as possible, so that I can work off of that to then talk about the implications of taxes on holding investments inside of a corporation. So again, some of this might be at the first really base level, but critically important to understand, that then visually I'll run off as I move into further topics. And I do want to say that I do appreciate the opportunity to be on here with Bill, because what I do with Meridian and other credit unions across the country, I am a support resource with them to identify issues that there might be for clients where they have either a challenge or an opportunity. And then those issues that we identify are then handed off and coordinated with local professionals like Bill to actually carry the ball from there. But then we continue to be involved where we can to provide the further input where we've got expertise, the investment, the financial advisor, myself, not a non-practicing lawyer now, but someone who has worked for quite a long time working with financial advisors and other professionals. So that's the nature of it here. So I'm going to take you through the core of the content, and I'll keep an eye on the time so that I allow for the appropriate amount that Bill will then have his conversation. Now, I have 3 articles that will be shared with you subsequent here, which then have the content that tells the full story of the content that I'm speaking on. So where there may be gaps, it'll get filled in by that written material. One of those articles is this visual here, which is just the way that I like to represent how it is that that a business runs, and particularly a corporation. When you run a business within a corporation, I look at it as the earth, where the kind of money that you have and its form works outward from the core, where you go from cash that then becomes working capital, and then you've got capital reserves. That's all internal movement of monies for the corporation, for the business itself. And then you get to a point where you have excess beyond what needs to be reinvested in the business, and that excess breaks the surface, if you will, and becomes potentially investable by the operating company itself, if you want to do that with an investment portfolio there. Or you might establish a holding company arrangement where you can dividend from your operating company up to your holding company, usually on a tax-free basis, from a holding company up to its parent company. Or further beyond that, you might be dividending out from your corporations overall into your personal hands and investing money there. So I like this representation because I don't want to suggest to people that every penny that you've got in the business should be pushed into an investment portfolio. You need to take care of your business first. And as you get well established and you get to a point where there is that surplus, then you do have the opportunity then to invest your money either within the corporation structure or pushing out to your personal hands. So there are three basic structures that we use for running a business. You can run a business as a sole proprietorship, and in that case, you personally are taxed on the business income, the net business income that is earned. You could run as a partnership with one or more other people, and in that case, each of the partners have their allocation of the income of the corporation, and they are, again, personally taxed on that. You can have structures where a corporation is a partner, but let's keep it as simple as possible here, where we're just talking about individuals in the first place. And so each of those partners will then be taxable on their own share of the income. And then we have corporations, which there's a variety of reasons that you might set up a corporation that might limit liability. It's got much more survivorship than an individual person. If a person dies, then it quite often is the end of the business. It could be the case if you're a one person operating a corporation that likewise the business ceases at that point. But there is some continuity associated with a corporation. And then from a tax perspective, distinctively from either the sole proprietorship or the partnership, a corporation is taxable on the income that it earns, and then it can reinvest. So again, inside of the earth, it can reinvest into the business activity by again purchasing things that are needed for it, new inventory, capital, that assets that need to provide the machinery for the operation, and then when the distribution is made from the corporation out to the shareholder, the owner of the corporation, the one or more shareholders, then we have a second level of tax that applies at that time. And so I just wanted to make that distinction before I throw at you a bunch of numbers here. Apologies. I'm going to show you what the figures look like currently. And the only line that you really care about here is in the middle of the pack. You see Ontario showing up. I'm just going to look down here. I'm showing this at top tax bracket. The Ontario top tax bracket for an individual is about 53.5%. And then beside that, you see 12.2% for the small business rate, and then further over 26.5% for the general corporate rate. Now, what I'm showing you here is obviously a snapshot, but it's the representation of what happens when you have the corporation first as earning income and then the income being distributed to the individual. It's called integration, tax integration, or corporate personal tax integration. Corporations pay taxes at a flat rate. So those two figures that you see there, 12.2 and 26.5 for the small business and the general corporate rate respectively, those are flat tax rates for the corporation on the income that it earns. It pays that lower rate on its first $500,000 and then the higher rate on income above $500,000. There's some other qualifications to that, but that's the main criterion if you're operating your business in Canada. Whereas the individual that I'm showing here, this 53.5%, that is the top personal tax bracket rate, combination of Ontario and the federal government together. That's how much tax you're paying. In the meanwhile, you will have worked your way up through lower tax brackets until you get to that point of 53.5%, which is something over $200,000 of income. You'll pay lower rates at lower levels, and then you'll work up to higher bracket rates as you're going along. The way that I'm showing this here at top bracket is to illustrate it, because we can't put every single number on here. It would be that much more confusing. But the notion of integration between the corporation and the individual applies at any level of income. And the rationale or the opportunity that you have for investing money in a corporation, both to reinvest for business purposes, and then once you get to a point where you have surplus that can be invested in a portfolio investment, so stocks and bonds or mutual funds that you might choose to invest in. The reason why you can do that in an opportunistic way is because we have these two levels of tax. We have the corporate tax, and then before you distribute out to yourself personally, you can in fact reinvest that money prior to the dividend out to yourself personally. And then once you do have the dividend out to yourself, the next figure, as you're seeing beside each of the numbers that we were just looking at, beside the 12.2, we've got 54.1. What that means is when the dividend is then paid out from the income that was earned at the corporate level, you then will personally, between your ownership of the corporation and your personal tax, you will have paid 54% tax on the amount that is distributed out to you. So you've got this this difference between the two, about 40%. When I'm just going to focus on the small business rate, the difference between the two, you've got about a 40% difference opportunity to invest that excess money. Now, of course, you do have to live your life, so you're not going to just leave the money in there and not pay for your groceries. But as things go along, then you do have an opportunity to look at this and say, when will I start investing either in the operating company or maybe through a holding company? And then once I establish that, what is my time period with the proper advice from your accountant, from your financial advisor, for cash flowing that out to yourself over the course of your later years? I don't say retirement because a lot of business owners don't retire entirely until a much later point in time. But in your later years, when you're no longer operating the business in as active a way, then the drawdown of those investment assets can then supplement the living expenses you have in those later years. So just want to take you through this graphic of what happens when you have an income amount that your business owns, and that's our smokestack business over here on the left-hand side. The corporation earns the income, it pays its corporate taxes, and then the dividend that is paid from the corporation over to the shareholder, it doesn't have to happen immediately, as I said, but when the dividend is paid over to the shareholder, then the shareholder pays tax on that dividend, which is in notion, I shouldn't say this with Bill on here with a tax partner involved, but notionally, it's the difference between what the corporation already paid to the government, and then the top up comes from the individual, the shareholder. And that really is what the arithmetic is intended to do. Now, I'm going to show you the arithmetic, and I'm showing British Columbia because I speak across the country, and it would just be too complicated for me to keep all these slides showing up. It comes out of a spreadsheet, but I keep just the one to show the concept of what happens, and they'll show you the actual numbers for Ontario and the rest of the provinces. So if we have income which is paid as a salaried amount, then the corporation gets $1,000 of income. It takes a deduction for the salary paid out to the individual, and you're one and the same effectively as the owner of the business. You're in two different roles, two different hats that you're wearing. But if you cause your business, your corporation, to pay you out a salaried amount, then you personally are entirely taxed on that salaried amount. Corporation pays no taxes, and you net to $465 in your hands off that $1,000, which is where we get that is the application of that 53.5% tax rate that I was showing just as a single number just on the previous slide. And then alternatively, I'm just going to look at the middle one here. This is the small business rate. The further over on the right is the general corporate rate. Alternatively, what can happen is the corporation earns the income and it gets taxed on that income. So we have the corporation being taxed at its rate, which is 11% in Ontario, the combination between the federal government and the provincial government. So there's $890 that the corporation has available to then pay out of its after-tax money to you, the shareholder. And then through this process that I'm not going to go through the individual lines here, but through this process, then the arithmetic accounts for the fact that the corporation already paid some tax to the government, and then you as the individual will pay the difference. Now, it's not perfect math, but it ends up fairly close. And in this case, it's about a $10 difference on that $1,000. So a 1% difference between the two that you end up in your hands if it's paid as a dividend versus paid as a salaried amount. And it's a slight difference depending on your actual income level if you're below top bracket, but it still remains somewhere in that 1% give or take figure that you have in your personal hands. All right, so I wanted to show you that process, and in the written pieces that you can mull over it a bit more. If you see over here on the right-hand side, we've got. I was making reference to the figure over there in British Columbia as the actual amount. It actually is 53.5 that their top bracket is as well. It's not exactly the same. It's 53.3 something, and rather than the actual number in Ontario, but it's very close. Here we have the Ontario numbers. Again, $465 you net over on the right-hand side, second row you see. And if it's paid as a dividend, you'd end up with $459 in your hands, or $446 if you were paid having earned at the general corporate rate. So again, within a percentage point or so that you have in your personal hands. So a lot of math that I'm throwing at you there. I appreciate that. But I wanted you to understand the process that the tax system is designed so that you don't pay double tax, so that the collection of taxes from the Canadian earner of the income is the same to the revenue collector, the Canada Revenue Agency, the government. It's the same whether it's earned by and taxable to one taxpayer as a sole proprietorship would be the case, or through this process of corporation first and then individual. And then from there, what I wanted to turn to is that we get that small business rate, particularly that 12.2% on our first $500,000 of business income, active income as it's referred to. But passive income does not get that small business rate. Passive income is subject to higher tax rates than what the active business income is. And in fact, it is taxed in a way that emulates the corporation being taxed at the highest tax bracket. So visually, similar to the one that I just showed you there, what happens is we have the passive income earned by the corporation, and the corporation pays tax plus an additional amount, which is refundable tax, meaning that it is refunded back to the corporation from the Canada Revenue Agency when a dividend is then paid over to the shareholder. So the corporation is made whole again. It gets back that excess tax once it pushes out the income to the shareholder. And once again, the shareholder will pay tax on that distribution that takes into account what the corporation has already paid. So that's most of the graphics that I've got here, and I just have a few summary points to wrap up here, to give you some guidance, some tips on passive income and its benefits to you as an investor if you are investing that excess cash in your corporation. So first off, you are allowed to earn passive income in a corporation. Be aware that if you have significant passive income that you've earned in your corporation, once you exceed $50,000 of passive income in a year, then your ability to make use of that small business tax rate on the first $500,000 is trimmed downward. It's a reduction for every dollar over $50,000 of passive income. Then it brings down the threshold for the small business rate down further. So you get closer to the point where your business income will be taxable at the general corporate rate, 26.5 rather than 12.2. The refundable taxes, there have been some changes over the last few years or a few years ago that makes it more challenging for a corporation to recover those refundable taxes. It used to be a little bit more wide open that dividends out of the corporation that were generated from any kind of business income would recover those taxes from the government. Now it pushes you towards dividending out income that is earned as passive income at the corporate level, pretty much dividending that net amount out into personal hands very quickly as that happens. And so I'll leave this last point about whether a corporation may be carrying on active business activity, because I just want to make one more point here before I wrap things up. One of the things that you can do with the excess money that you have is if you don't, again, you don't need it for running the business operation and you don't need it out into your personal hands currently, you may have very good reason to have life insurance to support the business itself. If you are no longer contributing to your household, then life insurance becomes a proxy of money that then is able to be drawn down if you die to continue to support your family. Likewise, in the business itself, if you have a larger business operation, it could be that money is needed then to sustain the corporation itself or the business itself if you are no longer there. So if you have a corporation that owns life insurance on an individual, then what happens is the corporation can use its money before dividends. So it's a more tax efficient way to pay the premiums on the life insurance. And then upon death, sorry to be so negative about it, but upon death of the individual who's insured, then the amount paid of the life insurance policy is paid from the insurance company over to the corporation. And the bulk of that amount, not only does it come tax-free to the corporation, but the bulk of it will generally be able to be transferred out of the corporation into the hands of a surviving spouse, who then becomes the owner of the business. As others might become the owner of the business in the estate, then the amount that can be transferred out tax-free might be adjusted a little bit. So I'm going to stop there because I think that's as much as you probably can digest at this point. I'm looking at my time. I'm at 12:26. So I'm going to push it back to you, Mishka, and you can take it from there.
Doug, thank you so very much. This has been so informative, and I think there's a few questions that probably are coming forward from the audience as well on some of the slides that you have shown, so I really appreciate it. But before we get to those questions, I'm going to pass it over to you, Bill, for your part of the presentation, and then we'll address the questions that have come in via chat and email and in other formats. So Bill, over to you.
Perfect. Thank you, Mishka. So good morning, everyone. I'm going to present a few pieces today. The main piece, and to start, is on some of the new underused housing tax rules. So these rules were proposed and they came out in 2022 and took effect at the end of 2022. So I thought it was important. We've been doing a number of sessions with our clients and with our non-clients, just kind of educating people in terms of what these rules are about and how they impact people. Unfortunately, in some cases when the government comes out with rules and the intent doesn't always translate to the actual practical application. And what we're finding is these rules and some of the filings that have come along with these rules apply to a lot more people than maybe was expected initially. And that's what we're here today to discuss. And then I added a few tax pieces at the end, just some items to consider for your 2022 taxes. I know most of you have probably filed, but if you haven't, just a few thoughts that you can add to. So in terms of the rules, so I mentioned the UH2 rules came out and were proposed in 2022. They are effective for any properties that are owned at December 31st, 2022, and that's the key date there. So anything that's owned at that date would apply to if either the tax applies or if the compliance applies. The main intent of these rules was really, I think, the government trying to focus in on kind of underused vacant properties. So foreign people coming in, buying residential properties, they're sitting there with no renters, with no dwelling, and that's part of what's driving up the housing prices in Canada. So the intent here was to apply a tax to that, to maybe discourage that or encourage people to rent them. But as I mentioned, unfortunately, some of the compliance and filings gone a little bit broader than that. So it's a 1% tax basically on whatever the fair market value of the property is, if it applies. It can apply to a wide variety of individuals. So not only individuals as persons, but corporations, trusts, and partnerships, which we can talk a little bit about later. Canadian citizens or permanent residents are exempt from the tax filing and any of the tax. The important part here to note, guys, is, being a tax guy, and I'm sure Doug can appreciate this as well, is, a lot of times when we look at residency for tax, there's certain rules that we base that on. These underused housing tax rules are actually based on citizenship. So you may not actually live in the country. You could be living in the US, you could be living in Europe, but if you've got your Canadian citizenship or your permanent residence, then generally these rules aren't applying. So it's a little bit different than what we usually expect for tax purposes. So I wanted to note that as it's very important. Corporations, trusts, and partnership will be subject to the filing requirement. So we call these people an affected owner. And what that generally means is they have to do a filing, and there's a form that you complete, and we can touch on that a little later, but they're not paying the tax. So the nice thing is the tax isn't being imposed on those individuals or that group of individuals, but there is some compliance to be filed. If you've got corporation, trust, partnership, or even individuals that are foreign shareholders, so truly non-Canadians, okay, so those that don't have their Canadian citizenship or their permanent residence, then that is when you could be falling into the tax, and this can apply. I think generally from what we've seen with our clients, we're thankfully not having the tax apply. We're not seeing a lot of that. Where I have seen a couple people get tripped up is we've got some folks that live close to the border. A great example is, say, Shirkston. So you've got US citizens holding a property in Canada. It's a vacation property. You know, they may not be renting it out. It may sit there vacant for most of the year. And unfortunately, in some cases, those individuals are falling into this tax. So something to think about there if you've got family, friends, clients, you know, that are potentially foreign or non-Canadians and hold property. The first return is due April 30th. I will touch on a little bit later that within the last couple of weeks, CRA has come out and identified that they would push the penalties, which you can see a little later in the slide. So they've identified now that the penalties and interest won't apply as long as it's filed by October 31st. But they've still set the filing due date as April 30th. So when I say that, really what it means is CRA takes an administrative position that they say the filing date's April 30th, but we're going to give you an extension and some wiggle room just because it's the first year. There's a lot of uncertainty around the rules, and they want to allow people a little bit more time to kind of get their ducks in order. They did something very similar a few years back, if you recall, when we were in COVID. So the tax filing deadline didn't change, but they allowed you to file late, not subject to penalties and interest. And they're doing a similar exercise here. The kind of biggest piece of this, and this is certainly where we've been involved with our clients, is they came out with some very significant penalties that that threw us off when we saw the original rules come out. So you can see that for those individuals that don't file the compliance or don't pay the tax, if it applies, is it can be up to a $5,000 penalty, and then as high as $10,000 for corporations. We'll touch on a little later. It's actually a filing by property. So that's another, you know, kind of pain in the butt here that we've dealt with. So if we've got an individual that owns 10 properties, we're not filing one form or one compliance form, we're actually filing 10. And the penalty can apply by form. So that's where it's been tricky. And like I said, we've been working with a lot of our clients to make sure we identify those that get caught up in these rules and need to file. Just a couple of situations to go through that I just touched on, but I'll highlight. So non-Canadian persons owning a residential property, and we'll talk about this and what's a residential property because it is important. CCPC, which for the purposes of this discussion, guys, it's just a corporation. Quite common. We've got a number of corporations that hold rental properties, so they've fallen into these rules. We've got corporations holding housing units for seasonal employees. So a great example of that is we've got a number of farm corporations. And those farm corporations have properties that are on within the corporation, and they're on the farm property, and they house migrant workers or workers during the summer. Family trusts owning properties, which again can be quite common depending on the planning tools that we use. And then we've got partnerships. One of the things that I wanted to note that I thought could be relevant to folks on this call, we do have a number of individuals that hold properties as individuals. So you file your taxes every year. You pick up your rental income and your rental expenses. You know, it's quite common. Where we've had some issues and where we've had some guidance by CRA is when you file your tax return, you've got two options when you've got a property that's, say, owned jointly. So let's say me and my wife own a rental. We can select co-ownership, which is quite common when you've got a husband and wife. And co-ownership's just once I pass, it's going to pass on to my wife or vice versa. The second option is you've got it held as a partnership. So now I've got maybe a property that I hold half, and then I've got a friend who holds half. Depending on what you've selected on your tax return, and it may be worthwhile to look at this, is if you've selected it as a co-ownership, and it is a true co-ownership based on the documentation, you're generally exempt from these filings and from the tax. If you've selected a partnership, then CRA is expecting a filing based on that property. So it's come up a few times where we've noticed in the past, for whatever reason, we filed the tax return and maybe partnership was selected 10 years ago and it's just rolled forward year after year and we didn't think anything of it. But CRA has indicated that if you're selecting partnership on your return, they are expecting a filing for 2022. So that's something we've had to look at for a few clients. Just a really quick flow chart, because that's what accountants do, just to put it in perspective. But basically what we want to determine is, first, is it a residential property? That's really the key here, guys, because if we've got different types of property, like an apartment complex, those nature, then they're generally falling out of these rules. But if we've got a residential property, which if we think about that, that would be a home, right? Detached home, a semi, condo, those types of things. Secondly is then, are we excluded owner? And to keep it really simple, an excluded owner is exactly like I said, are you a Canadian citizen? Are you an individual and you're holding the property? If we don't fall into those, then we need to look at, do some exemptions apply? So we don't have to pay the tax, but we still have to file the form. And that's really the exercise we've been going through with our clients in terms of, answering these questions and doing the analysis. I'll just walk through a couple of key pieces here. So in terms of the owner, and again, where we found some challenges is the owner is the individual or the entity, whatever the case may be, that's identified on the land title. So you'd be surprised to find out that, in some cases we've got someone that, believes they're the owner or the ownership's reflected in a corporation or a partnership. But if we actually go to title, that can be different. So the first step is really looking at who has legal title to that property, because it's whoever holds legal title that is ultimately responsible to look at these rules and file the form, okay? So that's step number one. You want to make sure that you confirm who holds title. You can go to the registry to confirm that and make sure. And it's basically any person. So a person can be an individual, it can be a corporation, it can be a trust, or it can be a partnership. But again, you want to go back to title and look at the land registration. Just quickly, I won't spend a lot of time. I touched on this. What's a residential property? So, it's a detached home containing no more than 3 dwelling units. And really, like I said, it's what you would imagine, it to be is there's a kitchen, there's a livable space, there's a bedroom, there's a bathroom, what would meet the definition. I talked about semis, we talked about row houses. Condos has been a tricky one as well, because when we've got an apartment complex, so let's think of a traditional apartment complex where we've got a building. The property tax for that building is actually just one bill. So it's all one unit. So we may have 100 apartments in there, but if we look at the property tax assessment, it's just one unit, okay? If we look at a condominium building, each condo itself has its own property tax assessment and its own property tax ID. And that's when we're actually into the filing here that wouldn't be with an apartment. So again, that's been a bit of a tricky one. A little painful in some cases, because you can imagine some clients have condo units with 100 units. And unfortunately, like I mentioned earlier, it's a filing based on per property. So in some cases, we've got clients filing 100 forms or 150 forms, which you can imagine is quite onerous, but something to keep in mind. It does include the land, which we call reasonable to the property. So if we think about that, if we've got 40 acres, generally what we would say is an acre or two of land is really related to the house. And that's only relevant if we're actually paying the tax and we have to determine what the value of the property is. Quite often with our clients, we're finding that we are getting exempt. So we're getting in those exemptions, which is great. So the fair market value is less relevant. But if you do have a property that's got a large amount of land, generally we say about 2 acres of that land and building is what we would call the residential portion. Mixed use is an interesting one. So there's kind of varying opinions on that. We've had a few situations. When I say mixed use, imagine, commercial property on the bottom with apartments on the top. If you think of St. Catharines, quite common. So we've got commercial property, which doesn't fall into any of these rules at all. But then we've got residential properties on top, which do. So it's just a matter of determining, the square footage, what's the usage of the property, and looking at those. But if you do have mixed use properties that you own, you may want to consider looking at these rules. We talked about excluded owners, so I just wanted to highlight a couple just to point out. Mainly the two are, so registered charities, thankfully, don't fall into any of these rules. So any of you guys that deal with charities or are on the boards of charities, I know that was some relief, because charities quite often can have properties depending on how they're structured. Municipal organizations are excluded. The main one, like I said, is an individual. So an individual is a Canadian citizen or a permanent resident. Without getting too complicated and too convoluted, one thing we do have to watch is when we have what we call an in-trust relationship, okay? And what that could mean, I'll give you guys an example, is I can have a corporation set up, and Doug was talking about those structures, and the property I hold is in the corporation, meaning it's on the books, all the expenses, all the revenue flow through that corporation. But if we went to legal title, and I mentioned that a little early, legal title, I'm legal title of that property. So what that relationship really is I'm holding the property in trust on behalf of the corporation. So the corporation is what we would call the beneficial owner of that property, and they're going to incur the tax, and I'm the legal owner. That relationship can get you to fall into these rules because you would think, well, I'm Bill, I'm a Canadian citizen, I get excluded, but you do have to watch that and be mindful of what's the actual structure and how is the property held. I'm going to go through some exemptions quick for you guys just to highlight. The first portion of these exemptions are directed towards actual foreign, so foreign individuals are non-Canadians. And then I'm going to highlight on a couple of the exemptions that we're seeing that apply to most of my clients and our clients at M&P. So the first one is primary place of residence. So pretty self-explanatory. So if we've got a non-resident who owns a Canadian property and they're living there, maybe they haven't received their permanent residence or the Canadian citizenship, you know, maybe they're living here for a period of time, you're able to get an exclusion. So just, again, intuitively think if you're actually living in the property and that's your primary residence, then you're not subject to the tax. We've got multiple properties. So again, similar in terms of maybe we've got a non-resident, a non-Canadian who owns multiple properties. One of those properties they can claim as their primary residence. The other kind of nice piece is that you can actually look to family members too. So it just doesn't have to be the individual. So again, let's use me example. So I'm on title, I'm the non-Canadian. If my spouse, if my children, if related parties, which could be family, live there, then we can look to get an exemption as well. Qualifying occupancy, which is essentially our people living in it, right? And again, to go back to kind of what was the intention of the rules, if you're a non-resident, a non-Canadian who owns the property and you're renting it out, you're not going to be subject to tax, right? That's what they're really trying to drive at, is they want to make sure that the property is available for rent, helps the rental market, helps the housing market. So as long as you meet that qualifying occupancy, which is essentially that the property was rented or someone was dwelling there for more than half the year. Again, I won't get into some of the little nuances, but as long as the property is being rented, you can generally get that exemption. Limited seasonal access. So again, we talked about, I'll go back to that farm example maybe. So maybe we've got a property that's only used in the summer. Another good example is maybe we've got a cottage that's not winterized and is only available in the summer, right? So you can't actually physically live there in the winter, even if you wanted to. So in those cases, you can also get an exemption if it's just a property that's only available throughout the year. Disaster or hazardous conditions. So a couple of these next ones are actually looking at the property in the year. So let's say in 2022, for example, there was a natural disaster, maybe a tornado hit, damaged the property and it wasn't livable. We're able to get an exemption from the tax that year. So obviously if the property is not livable or something happened to it that we couldn't have renters or anyone dwell on the property, they're allowing you an exemption. Same thing goes for construction. So it's certainly not uncommon that we buy a rental property and at some point maybe we have to do major renovations. So if that is the case, there's an exemption in that year that if you've done some renovations and the property hasn't been livable, that you're allowed an exemption for that year. If you purchase the property, so another exemption, again, looking at non-Canadians, is if you purchase the property in 2022, they give you a carve out for the first year. So you get an exemption and then you'd have to look at the rules for 2023. So it's really just kind of, we'll call it just a segue that allows you to buy the property and you're not immediately on the hook for looking at these rules and do the analysis. Same thing applies for the year of death. So if we've got a non-Canadian and non-resident, that individual passes away, they allow you an exemption. The main driver of that is it's obviously very onerous for a trustee or an executor to come in and they're already dealing with an estate. You know, if it's truly a non-resident, it's probably complicated from a tax perspective dealing with Canadian tax. So they don't want to add, you know, additional onerous kind of activities here. So they allow an exclusion, not only for the year of death, but the year following as well. So you get kind of 2 years there that you don't have to file or worry about the tax. Lastly is vacation properties, and I'll go back to the example I mentioned, guys, with the Shirkson property, and very common in terms of what we see. So if it's a vacation property and the individuals are using that property for a period of time, in addition to it's not what we call a metropolitan area, so let's say it's more of a rural area, cottage country up north, then you can get an exemption from the tax and look at that. So that may be common for, like I said, some of those US folks that are close to the border that have properties in Canada. That may be something that they want to look as an exclusion. The next three, and I'll go through quick, I know we're getting close to time here. These are the common ones that we're seeing with our clients. So if we've got what we call the specified Canadian corporation, so again, to go back to what Doug outlined, if we've got a corporation that's holding the residential property, we're generally getting exempt from the tax. So where we're having some of the challenges is we're having to file the form, which can be painful, but there is no tax that applies, which is great. So any kind of corporate structure where we've got rental units, which I said is very common, we've got a number of clients in that space, then we're looking to file the form, report the information that the government's looking for, but no taxes applying. And to keep it very simple, the way that we meet that rules is if we've got Canadian shareholders. So if we've got a corporation and we've got Canadian citizens that hold the shares of that corporation, we're getting that exemption. The next one is when we look at a trust. So again, we've got trusts that hold property for various reasons. As long as the beneficiaries of those trusts are, again, all Canadian citizens, then we're getting an exemption. The only one quick point I wanted to note on the trust is we have to look at the trustees of that trust, and the trustees are the individuals that are named on the trust deed. Each trustee has to file this form. So again, I know it sounds ridiculous in some cases, but if there's a number of trustees, then it's not just one individual that files the form, rather say three, if there was three. And the last exemption is the specified Canadian partnerships. So again, we've got a number of partnership structures when we look at our real estate and construction niche in our firm. And we've got partnership structures holding property. As long as all of those partners are Canadian, so they're Canadian partners, whether they're individuals or corporations, then we're exempt from paying the tax and then just still dealing with filing the form. Quickly here, so I did note, so it's for any properties held at December 31st. Current filing is still due April 30th, but they did offer to extend and not apply penalties and interest as long as it's filed for October 31st. So the nice thing is people can kind of take a breath and take the summer to maybe review these rules more closely. Mention the penalties, so obviously pretty significant and pretty painful. So just keep this in mind. If I've gone through any of the slides and you think any of this is applicable, we'll certainly address some of the questions. But you can also reach out to me directly. We can get the slides out to share and have that information, but you do want to keep that in mind. And the last piece is that the assessment period, so again, to keep it simple, is that the assessment period is how long can CRA kind of come back and look at this. There is no timeline on these forms. So if they identify in 10 years that you haven't filed the form for whatever reason, they can go back to the beginning when you should have and apply penalties. So something to keep in mind, that it's not one of those things that in a couple of years it kind of goes under the rug. So we talked about owners that are non-resident. We definitely want to look at that. Maybe challenging for some owners that, again, we didn't initially think we're going to fall into these rules. We didn't think they were part of the spirit of the rules, but they have. And last thing is I've been dealing with a bunch is home builders, unfortunately, have been caught in these rules as well. So they've got homes that are built, show homes. So again, if you've got clients, family, friends that are in that space, they may want to have a look as well. Just touch on a really quick couple tax things and we'll jump into questions. So the home office deduction for 2022 is still available. So hopefully most of the folks on here know about that. You've been able to claim that kind of flat rate. It's $500 for 2022. So if you worked at home at all during COVID, during 2022, they've allowed this deduction to move forward. So keep that in mind. Home buyers tax credits going to get bumped up, which is great. So still available. So if you've got family, friends, clients, and they bought a home for the first time in 2022, they can still get that first time home buyers credit, which is looking to go up as we move forward. Home accessibility credit. So I just wanted to note this. So if you've got individuals in the house that have maybe a disability, maybe you've got mom and dad or grandpa and grandma living with you, and you've made renovations to your home to make it more accessible and easier for the individuals. There is an accessibility credit here. It doesn't have to be for yourself, so it could be for a dependent. So something to keep in mind if you've done anything during 2022. Staycation tax credit. I know we've dealt with a bunch of this in 2022. So They were really trying to promote and get people out in Ontario. Obviously, after lockdown, you can imagine the impact it had on hotels and the tourists. So if you did have some vacations, maybe Great Wolf Lodge, maybe you went to a cottage, you can keep those receipts and can actually claim those and get a credit in 2022. So something to consider. Just understand it does have to be in Ontario. So if you took a trip to PEI and stayed in a hotel, it doesn't apply. It's specific to Ontario properties. And the last slide, just important to note, the effective in 2023, they're going to come out with a tax-free home savings account. It's a great tool. Some of you may be aware that previously through your RSP, you could do the home buyer's plan. So meaning you could make an RSP contribution and then you could withdraw a certain amount towards the purchase of your home. And it wouldn't be considered a withdrawal that had to be taxable in that year. The nice thing with this tax-free first home savings account is it allows you a deduction for tax purposes. So when you make the contribution, you actually get a deduction, but the withdrawal isn't repayable like the home buyer's plan. So it really acts almost like a tax-free savings account, except you're getting a deduction for tax. The only caveat is it's specific to purchasing a home. So when you put the money in, you can't withdraw it for other reasons, buy a car or take a vacation. It has to be for the purposes of buying a home. But it's a really effective tool that not only gets you a tax deduction, but allows you to save some tax-free dollars to put towards a purchase. Last piece, multi-generation home renovation tax credit. So just again, if we've got seniors, maybe we've set up a grandpa and grandma suite and we've done work like that. It's becoming more and more common with the cost of living, with the cost of homes. So if you've done anything like that or renovations where you've separated a spot of living for a family member, there may be a credit there available. And then the flipping rule really quick is just if you bought a property and sold it within 12 months, keep that in mind as that can be a little tricky for some of the new rules as we're moving forward. So you are required to report any principal disposition. So if you bought a home and sold it, you report it. It may not be taxable and likely is not taxable in Canada. But if you bought a property and sold it within 12 months, there's a little more reporting and information required that you want to look at, that you want to move forward as of 2023.
Thank you so very much. I think it's been extremely informative and actually interesting enough, especially your the last couple of slides actually addressed a couple of the questions that have come in and I think answered them. So in light of us only having about 8 minutes left, I'm going to go to some of the questions that have come forward and seeing if we can address it and have enough time to address it. Doug, I'm going back to you just for one particular question, and that was a person who is thinking of setting up their business, and they're wondering how to best structure it to basically take advantage of the types of tax advantages that are available to them. It's a small business with a low net income in the first 3 years, but they're wondering about it and if they or if there are any resources that are available to them that they could turn to.
Yeah, I think that at the early stage of a lot of businesses, even though setting up a corporation further on in time gives you more flexibility of how you manage both the business income and then again, eventually the surplus amounts. The practicality is that most people will start in a sole proprietor position because there are extra costs involved with running a corporation. And it just may not warrant it proportionally to be paying those extra costs in addition to trying to get the business running. But once the thing is running, then you can turn the corner and incorporate thereafter. If you start as a sole proprietorship, you don't have to forever be in that structure. You can move over into a corporation. And the other part of having a corporation is that we do talk about the limited liability associated with running a business through a corporation. But practically, if you're dealing in terms of your financing and even with some of your trade creditors, you might have to be signing off on personal guarantees anyway, which kind of neutralizes that, again, while you are still quite small. And then hopefully you can push past that as you continue to run the business successfully.
Excellent. Can I ask you one more question? And that's from another individual. They are sole proprietor and they're asking if they can take out their own benefits like CPP, EI, and others.
I'm going to turn that over to Bill because that's a business operational question more so, which I could reply on, but I think it's more appropriate for Bill to comment on that.
Yeah, I can address that quick, Mishka. So the CPP actually applies when you file, so you don't get to elect or decide. So what will happen is the CPP will be calculated when you file your taxes and report your self-employment income. On the EI side, that is something you can elect. So generally you defaulted, you don't apply, it's not applicable, but you can always elect into EI if you like. Generally self-employed individuals don't, because the cost, doesn't necessarily outweigh the benefit. But that's that question.
Wonderful. Bill, and the next question I think is geared towards you. And this is, when we look across Canada, we see a high number of parents actually buying homes, assisting their kids with buying their first home in light of the rising costs that people are facing. And we've gotten a couple of questions in via text or email that are saying, what is the best way to set it up? Should they give an inheritance to the kids? Should they be part owner of the property? What are kind of the rough and tough kind of rules around supporting the next generation into home ownership?
Yeah, I can highlight a couple of points, Mishka. Like you said, one way in Canada that doesn't generate any tax is parents can always gift money to their children tax-free. So at any point, I can gift money to my children. There's no tax implications to them, and they can take that money and put it towards a down payment or towards the house. The only downside potentially to that is, like, once I gift that money and give it to the kids, it's gone, right? So I have no legal entitlement to get the money back, or I can't decide on how they want to use it. So the other option is we can have a loan, so a bona fide loan agreement where I'm the parent, I loan the money to my children, and we've got a loan agreement. Can achieve the exact same goal, so it allows them to use the money, make the down payment, but I've got a document in hand that just says, at some point, if I want, I can collect that money. Generally what happens is, in the will, the parents will forgive that loan or that note, and it's gone, and there's no tax implications. But it does allow them some legal standing, at least, to have entitlement to the cash if they wanted to do that basis. Hopefully that helps.
I think it does help, actually. There's another question that has come in, and the first question was, is there any way on reducing paying taxes? This looks like it's coming from someone who's retired. They only are relying on their pension income and are withdrawing a little bit from mutual funds and investments that they have, and they don't have any deductions except disability credit. Are there any suggestions for that individual? And I think, Bill, I kind of think it's likely your area.
Yeah, I would say, Mishka, one of the great benefits that came out a few years back was the pension splitting. So the ability for seniors to split income, or we may have one senior earning pension income higher than the other. It can be quite tax friendly. So quite often that just flows through your tax return, and hopefully if you've got a preparer or someone that can assist you with that, I would suggest that's a great tool. In terms of, and Doug could certainly speak to this, if you're looking at your investments, you obviously have to look at your risk tolerance and what's important to you, but capital gains and dividend type income are tax friendlier than what would be interest income. So meaning if we're really heavy into savings or bond type investments, you're going to have a bit more of a tax liability than you would more on stocks and maybe dividend types. So you got to have that discussion because you have to make sure it fits your risk tolerance. But from a tax perspective, you could look at that as a bit more of a tax efficient way to get your money out.
Excellent. Doug, do you want to add something to?
Yeah, I think I'd add into that. Appreciate that opener there, Bill. The common way that we reduce taxes in a household is to be able to legitimately split income between spouses. That is the core of it. With a business, you can deduct expenses that are related to earning income, but when you're talking about a family and a couples, it is you're targeting towards dividing the income between the two of you as much as you can legitimately. One of the cautions I would say with that right now is that you may, I'm speaking to the person who wrote the question, you may have heard that you can use what are called spousal loans or prescribed rate loans, where instead of giving to the other spouse who then invests it, because it ends up being taxed the person who the spouse who gives, you set up a loan instead between the two of you. That was a really good idea and effective strategy for about the last decade and a half, because the rates that had to be charged between the two were down around 1%. But with the inflation that we've seen over the last year or so, it's up much higher. It's 4%. It's going up to 5%, or maybe we're at 5% as of April. Bill, you can correct me for those kinds of loans, which kind of puts that off the table. So you're back to the things that Bill mentioned. Be tax efficient in the choices you make with your investment portfolio, and that is the driver. Taxes should follow in behind the investment and the risk of the investments that you have, and then the tax implications of that should then support it, not be the leading consideration.
That's an excellent point. And on that note, I have to say we're actually at the top of the hour. It's 10:59. I think time just flew by. But I actually really wanted to thank both of you, Bill and Doug, for being and sharing such informative information to many of our attendees, and then it will be distributed through our network. So thank you very much for being with us. We will share your information and your contact information with our members and attendees as well. And I have the sense that there's a lot of follow-up questions coming forward. Today's webinar was brought to everyone by Meridian Credit Union. So our thanks go to Meridian Credit Union for all that you do, not just for our chamber, but also the community. And for all attendees, thank you so very much for being with us. The webinar will be available at gncc.ca and it will be emailed to you. And on that note, on this beautiful spring day, I wish you a wonderful one. Thank you.